Do you feel Dutch taxes are too high? Are you upset that the taxman is squeezing you for all your dues? This trick will help you. It'll only work if you have a bit of cash on hand or if you have like liquidity available, such as shares that can be sold. But if you have that, this will be great for you. We have to talk about this right now because the tax service calculates these things once per year and the year is almost over, so this is why I'm making this video right now. This trick is called aftrek lijfrentepremies. We essentially sacrifice part of our income for retirement. So we formally put aside the money until we're 76 years old. Wait, let me explain before you close the video. Because I guess most of you are not close to 76 years old like I am. But this is like extremely tax efficient, for one. For two, we can potentially work around this 76 limit. And three, this trick doesn't require you to own a business, or it will work for anyone who's working. I'll go into more details on this point later, but first let's explain what we're actually doing here. So we send the money to a special account which blocks withdrawals. This is like formally setting aside the money for retirement. The tax service will not count the amount you put aside towards your income and you get an aftrek. Okay, so suppose you have an income of like 60k, you're gonna apply this trick, right? So first of all, we start with the net income of 43,714 euros. If we don't apply the trick, so we don't send any money to the block, which means we're essentially being taxed for 16,280 euro or something. This is like the base case. This is what we're probably currently doing. Next, we apply the discount and we see that we end up with an income of 45,905 euros. So we essentially save 2,191 euros, which I think is a lot of money. And if you work for a company, you'll get this money back from the tax service after filing income tax. But you have to actually file income tax. I had an accountant do this for me. Out of 81,000 profits from my company, I sent 15,000 to a blocked account, making my taxable income 65,000 instead of 81,000. If we go to the KVK website, we can see that originally I was supposed to get 49,971 euros in net income, but I ended up actually getting 56,272 euros of net income, which saved me 6,301 euros. So I actually did this last year and it worked out great. So the reason why you're saving this much money by setting aside money for retirement is because you are actually moving the highest taxed euros to your blocked account. So your overall income is taxed less aggressively. So we have a progressive tax system in the Netherlands, meaning that the more you earn, the more taxes you pay. So those top euros are actually paying the highest amount of taxes. So you want to like reduce that as much as possible, right? The system is designed intentionally like this. So they actually really want you to save for retirement. But please do note that there's like a limit on how much you can send into retirement each year, which is called the jaarruimte. And I think it's like around 15%. You should probably look it up as well. But you can use the 7 previous years as well for this trick. Usually a lot of people have like a large amount of money they can send to retirement if they have never done this. Okay, so like next question is, where do you actually send the money? And there are actually like several options here. The first one is, for example, with Nationale Nederlanden, you can choose like bank savings. I probably wouldn't recommend bank savings because they offer you like a fixed amount of interest per year. But this usually tracks inflation or is like lower than inflation. Maybe you get like 1% points above inflation. But this is probably not what you want over a 30-year period. It's like it won't have any meaningful impact. It's just way too low returns. Then they also have like normal funds. So these are like managed funds, and they will like invest the money for you. These can be a good option, but you actually have to like look at the past returns and make sure that they were consistently like outperforming the market. Because you end up paying so many fees that you're actually underperforming the market. So yeah, be careful with that. So what I actually looked for like the safer option, which is essentially just buying an index fund and putting it in like the S&P 500, for example. So I didn't use this thing, the National. I used the Giro instead. And this is just a like do-it-yourself brokerage, but they also offer a blocked account. Essentially, this account looks pretty much the same as a normal brokerage account from the Giro. Like it has the same colors, it has like the same layout. But if you click here, then you can see that I am not allowed to do this, I think. So they're actually saying it in the warning here. You're sending money to the pension account. You're not allowed to just book out money from here. If you're sending money to your pension account, then it's blocked until you're 67 years old, essentially. So I sent like 15,000 euros to this account last year, and it has been like, you know, just being in the stock market, and you can see that I have had some amazing returns because I just dumped it all in the S&P 500. So not only did I save 6,000 euros in tax, the money I should have paid on tax has actually been yielding me a return. Hi, Editor Yappie here. I feel I should like point out on a side tangent like why avoiding these taxes is so important. So here we can see the 15,000 euros I set aside in like the retirement account. And this would have been the money if I would have actually like put it through income tax and then put it into like a normal brokerage, right? We have these insane returns this year of like 33%. It's a bit higher actually, but you know, it's crazy amount of returns, right? And we can see that even with these crazy returns, the taxed currency is not even on the base amount yet. You would actually need to have like a return of around 70% to approach the base amount yet. So by avoiding these taxes, we are essentially getting a free 30% return, getting the normal outpacing as well. So this is like, if you do this every year, you end up like saving so much money. It's crazy. And that's just because the Dutch tax system is brutal. Furthermore, this money that's on the retirement account is not taxed via box 3. So because this is not part of my wealth, it hasn't been income taxed yet. It's not on my balance sheet, according to the tax service at least. It can just grow without being taxed. So like it's fully tax protected account. And this is all intentional. However, the flip side is like once I'm 67 years old, it will actually be income tax. But the flip side of that is that the income taxes for 67 years old are also a bit lower than for people that are working right now because they don't pay into the AOA. So AOA is like Social Security. Okay, so we get all these advantages. However, you know, it's being blocked until I'm 67 years old, which is like, you know, 35 years or something away from me. That's kind of bad. So I might as well just like put the money on fire and it would have been the same current situation. Yeah, like, you know, we want to spend the money right now. What do we do about this? The solution to this is fungibility and debt. So because we are like having this claim of wealth, which we currently can't access, but we can access in the future. What we have to do is we have to take earnings from the future and bring them to now. And the way to do that is that we, so I mean, like I probably wouldn't recommend this. It's highly recommended on your risk tolerance, but this is something you can do. And I don't think the people actually thought about this when they designed the system, but suppose like, you know, I'm not 32, but it's probably a bit insane to take out debt against my retirement right now. But if I'm like, you know, 60 years old or like 50 years old and I want to like buy a house, I can go to the bank and say like, look, I got this giant retirement account. You know, the 20K will grow to like maybe 200,000, right? We keep putting money in there and it will just like be my retirement fund, right? And I can say to the bank like, hey, I got all this money in retirement. Could you give me a mortgage? And normally they would say no, but because I have all this money in my retirement, I have like some kind of income, which is a bit more robust than the standard Social Security, AOA. And therefore they're more likely to actually agree to that. In a way, because I'm so young, I'm sort of throwing the money away. But because I'm so young, it also has like a lot of time to grow, and later down the line, I may be able to work more. But I probably would, if I would actually do that, I probably would have to move the retirement assets into safer assets than stocks, you know. They probably would ask me to put it into bonds or something. I don't know if this is like, yeah, this is like some serious financial engineering, I guess, but I like coming up with these little loopholes. Anyway, so what we have here is we protected our highest tax income from the tax service and put them away for the future. We avoided box 3 taxes over time, so that's really good. And we are still potentially able to spend the money right now with debt and fungibility, depending on your risk tolerance. I would add that asterisk. So I hope you enjoyed this content, and if you have any questions or comments or ideas, then please leave a comment below. And like the video if you like the video, subscribe. See y'all later. Bye.